Hello and welcome back to a special edition of the Life by Design podcast. I'm with Doug Walters.
Jay, how are you?
Good. I'm doing well. It's been a little while since Doug and I have done a podcast together.
Yes, yeah.
So we're excited. This is our Q3 25 perspective. So we're going to take a look back at quarter three and a little bit of a look ahead towards Q4.
Right, exactly.
Perfect. So with your perspectives, if you guys haven't had a chance at home, we always, Doug's weekly insights, we do one a quarter that's called Perspective, and it kind of lines up with this video and this podcast as well. And you named it a market under no obligation to make sense.
Yeah. Yeah, it's a little bit of a nod to another podcast that I like to listen to, which is Star Talk, Neil deGrasse Tyson. His quote is, "The universe is under no obligation to make sense to you." And I felt like it was particularly appropriate right now because we have a market which on the surface appears to not be making sense, perhaps defying gravity.
Yeah.
You can get into that a little bit.
Yeah, I'm there, and there's a lot going on in different, in all different areas of the market, right? And you were kind of talking about the third quarter picking up a little bit where the second one left off.
Yeah, it was a pretty good third quarter. Yes, by all estimations, it was a very good third quarter, and it wasn't all driven by U.S. large cap, which we can get into. Some of it was driven by small cap. We obviously have had gold, and that's probably worth the talk here as we get into it. But the real defining moment was the first rate cut we've had in well over a year. So we've had cut rates by 25 basis points. We hadn't seen a rate cut in well over a year. And we saw some rejoicing by the markets. And when I say the markets, we tend to use that generically often to refer to equity markets, but there were other markets that we seem to be rejoicing as well.
So now that rate cut, just for me to understand, is that within the realm of the numbers that a normal rate cut would look like? Is that kind of where they try to stick?
Yeah, that is sort of the base cut, if you will.
Yeah.
It has always been, as far as I know, in 25 basis point increments. So, about 0.25% at a time. Sometimes you'll see 50 basis points. In more extreme scenarios, you might see bigger numbers, but 25 is sort of a nice gradual move.
And so, and I'm sorry if this is a little 101 for some of our listeners, but, maybe there's someone that out there that wants to know kind of what is the idea behind any rate cut, not just this one in particular, but any rate cut. Like, what is the concept behind that that's affecting the market, or what they're looking to do to affect the market?
Right. And it's probably worth taking a little bit of a step back. The Fed's mandate is twofold, right? It is they're trying to control inflation, make sure inflation stays where they want it, but also make sure we have full employment in the United States. So they have that dual mandate. And when you cut rates, you're going to basically put a little juice into the economy. It becomes cheaper to get a loan. It's sort of the easiest way to think about it. So that will spur on new lending, new projects, more economic activity. So when they're cutting rates, they're trying to spur economic activity.
Okay.
The risk is that economic activity can increase inflation. As activity picks up, people have more money in their hands, they're paying more, prices go up. So they're always sort of playing that balance. And what they were waiting for, why we've been waiting for more than a year, is inflation has been a little bit sticky, higher than they want it. They'd like to see it down around 2%. It's kind of been hovering around 3%, just under 3%. So they haven't seen the progress they'd like to see there. But we're starting to see on the other side of the equation, unemployment, signs that, employment market is weakening. So that's really why they're starting to act now.
Yeah. Okay. Yeah, I think that's great. See, there's things I need to know. And so with that, what did we start to see with like some of small cap and some of the market?
Yeah, so it was a benefit to small cap in the third quarter. If we think back over the last the first part of the year and even beyond that, the market's been driven by larger companies, mega cap companies in particular, these big tech names specifically. Small cap has kind of been left behind. But this rate cut helped small cap. So the first time in a while, we saw small cap outperforming large cap. Why is that? Why does a rate cut help small cap? Probably your next question. So think about, smaller companies tend to be more reliant on debt funding, right? They're going to be more likely to need loans, and more likely to need short-term loans. They may not be able to get a 30-year loan like Microsoft can. They're going to be lending shorter term, and they're also more likely to have variable rate debt, variable rate loans, meaning that rate cut is immediately going to lower their interest burden on the debt that they have. So that's a direct benefit to their bottom line, and it's why we saw small cap go up. And it wasn't just the cut this time, it's that there's an expectation that we'll have additional cuts in the coming quarter.
Yeah. And then also, and I'm, tying this in with gold continuing to be strong, right? We saw a little bit of weakness in the US dollar as well.
Right. Yeah. We saw this, these diverging trends, dollar falling and gold rising, and they are somewhat related. A weak dollar is going to sort of mechanically strengthen the price of gold. Gold is generally priced in dollars. So if dollars are weakening, its price sort of mechanically goes up. But there's other things driving gold going up. It's central banks have been buying, filling their coffers with gold. There's a lot of uncertainty right now, political, geopolitical uncertainty. The U.S., the U.S.'s balance sheet has, there's some concern about the strength of that balance sheet. That's going to simultaneously move people towards gold, but also weaken the U.S. dollar. So we saw this really diverging trend, and gold is up. I think at the time of print, it was up 47%. It's up even more now. This is just on the year.
Yeah.
So pretty spectacular. Well, the U.S. dollar is down around 10%.
Yeah. And so, with all of that, we're seeing gold, but also the international markets are showing strong because of the U.S. dollar weakening and then also tariff uncertainty. So we're seeing some of the results of the earlier tariffs a quarter or two ago.
Right.
But then there's also new talk of other tariffs going on as well, right?
Right. Yeah. The international, this is why, we'll get to, we always manage to squeak in diversification and the importance of diversification.
Yeah.
But this year has been a poster child for that, with international markets being really strong, international equities, emerging market equities. And again, the dollar down 10% versus other currencies really almost directly translates into 10% benefit to international equities, or a diverse basket of international equities. So they've been up more than that, for other reasons. But yeah, that weak dollar has really helped those international holdings.
Yeah. And so as we kind of are winding down on Q3, looking at Q4, maybe talking a little bit about what's happening with large cap and the market.
Yeah. I think the main sentiment we're feeling is, and you're seeing it in not just, feeling, but you're seeing it in headlines. The market's expensive, right? Valuations are high. Valuations are at an all-time high. Stocks are at an all-time high. You're getting these very sensational headlines out there. So I think it's really important at these moments to really understand what we're looking at and sort of temper any emotions those headlines might raise. So the way we look at it is we really want to understand that number, that valuation is high number. And what we find when you dissect the equity market is those mega cap tech names that have been skyrocketing for the last 5 years, they are very expensive. And I'm not going to say it's not justified. Time will tell if, the AI benefits outweigh, are able for them to boost their earnings. Maybe it's all justified, but they are very expensive based on historical perspective. But if you look at other aspects of the market, so small cap, international, emerging, they are either just a little bit expensive or a little bit higher than average, I should say, or not even expensive at all. Small cap, for example, is pretty much trading at or around where it's been historically. So to say that the entire market is expensive, I think is a little bit misleading.
Yeah, and so I think, as we also said, every podcast I think you and I have recorded, we always talk about, not basing any decisions that you're making today on emotion.
Right.
Right. And what we do here and what Doug's team and the investment team does is focus on evidence-based decisions.
Right.
So hopefully you at home, you heard Doug say that they're looking at all the data,
right,
and making a decision, not watching the news and hearing about something crazy with AI happening.
Right. Yeah, exactly. That data tells me you need to be careful about being too concentrated in large cap tech. But when you hear all-time high, again, that tends to spur okay, does that mean I need to sell?
Right.
Generally, a healthy market should be regularly hitting all-time highs. Right. We are in these investments because they tend to go up. By definition, they should generally be hitting all-time highs pretty regularly.
Right.
So the all-time high is not a concern. The valuation, yeah, that's what we want to understand. Has it gone too far? And we see opportunity elsewhere. We see opportunity in small cap, international, emerging. We're going to diversify, and we are diversified into assets like gold, which is also run quite high.
Yeah.
We still have a good allocation to gold in our portfolios, as well as fixed income, treasuries, et cetera.
Yeah, and I guess to go back to an old staple of ours as well, right, is though we're talking to you about the quarter and we're talking to you about 25, really, when you're looking at your investments, your assets, how you're doing 5, 10 years, that's kind of where you're looking to see how you're doing in the lifetime of your investments, not just for the quarter.
Right. We are thinking long-term. That helps us not fall into the trap of market timing, saying, all right, everything's too expensive, let's just go into cash. That's really dangerous, especially in an inflationary environment. You're falling behind if you're in cash.
Yeah.
We want to make sure we help our clients avoid those urges.
Yeah.
Keep them invested at a risk that is appropriate for them. That's different for everybody. We'll help you understand what that is, but it is important to stay invested at that level of risk for the long term to fully benefit from what the market has to offer.
Yeah, and I think that's great. And for any of our listeners, maybe this is your first podcast or video that you've seen, Doug and I have several podcasts deep diving into each one of these topics. I've done several with Greg Medical on behavioral finance as well. And so if you want to hear about the philosophies at a deeper level, you can go back and listen to all those. And yeah, so Doug, is there anything else going into Q4 that you want to talk?
No, I think that's it. Just keep your nerve. The market's generally at an all-time high. That's normal. We've got our eye on the valuation. We're keeping our portfolios diversified. So stay the course.
Yeah, perfect. Thanks, Doug.
All right. Thank you, Jay.